Learning Objective 5A is a stock split, where we looked earlier at what happens with preferred stock. Now let's look at what is quite typical of common shares. A stock split is where the company gives you certificates. There's no money passing through your hands, but you are getting additional shares, legally issued shares. And we do this because sometimes our stock price is getting out of range or it's a little too high. Let's say Amazon has a stock price of $500 a share, and it doesn't want to trade at that much per share. It wants to trade in, say, the $100 range. In that case, Amazon would declare a 5-for-1 split. That would have you own 5 times the shares that you currently own. So that would have the effect of having the price of $500 per share to be divided by 5, or down to $100 a share. No money changes hands. Your net worth didn't go up, but the number of shares you held goes up by 5-fold, and the price per share in the marketplace drops by 1/5 or to 1/5. In theory, the total market value of your stock is identical pre and post stock split. Now I said theoretically because even though no financial value is created simply by having a stock split, as a reality, stock tends to go up when the stock splits. And the reason is there's a messaging or a signaling to the public that the company feels that the stock price of 500 is not going to come down on its own, and therefore they need to do the split. And so the signaling tends to create a bullishness or a positive feel about the future of a company, and that pulls up the stock value. So the stock split per se doesn't cause the value of the stock go up, but the implication or the impression that the company and management and its board all feel that the stock price is not coming down, it's going to keep going up, makes people feel like, oh, it's going to go up, let's keep buying some. And that's why stock prices tend to rise. There are no financial statement effects because all we're doing is indicating that the par value dropped because of the split and the number of shares went up. There is no financial effect. But of course, anything to do with stock, we disclose. So we will disclose the nature of the split and the effect on the outstanding shares and the par value of the stock. Next is a stock dividend. Even though they sound similar, they're very different. A stock split is where you hold stock and they give you more stock, and it tends to be a big amount, like 2 shares for every share or 4 shares for every share. That is the stock split. A stock dividend is smaller in nature, and these give you some additional shares for the holdings you have. This is an example where the par value, the difference in the treatment is the par value does not change when you give a stock dividend. However, the shares outstanding do rise. We'll go through this table that shows how this looks. Let's look at stock dividends, and they're broken into the size of the amount of shares issued. In a stock split, if it's 100% or greater, in other words, 100% means for every share you have, you get 1 share, right? So that would be a 2-for-1 split. In this case, the 2-for-1 split would have no effect on retained earnings, but the par value would reflect that the par value is cut in half and the number of shares would be doubled. The common stock to par also has no effect because all we're doing is doubling the number of shares but cutting in half the par value. And then the paid-in capital, no effect. No money change hands, so there's no change in the additional paid-in capital. A small stock dividend is less than 20 to 25%. So in this case, we would show that the retained earnings would go down by the market value of those shares distributed. This is just an accounting rule. I can argue both sides of this one, but the rule is for a small stock dividend, retained earnings goes down equal to the market value times the shares issued. Par value would not change in this case. It only changes under split. Common stock would increase by the number of shares times the par value, and then the additional paid-in capital goes up by the excess of market value over the par value. I like to think of a small stock dividend just like they gave you cash, and you went out and took the cash and put it back in the company buying stock at that price. So if you were to do that, the cash would have gone up, but the effect on the equity side would be common stock goes up by par and additional paid-in capital goes up by the excess of market value over par. So it's similar in some ways to we gave a cash dividend and they bought back stock with their money. But the actual transaction shows here. A large stock dividend, which is bigger than 20 to 25%, that is seen as a reduction at par value. The big difference between a small stock dividend and a large stock dividend is small is recorded at market and large is reported at par. Look at what happens in retained earnings. It goes down, but only by par value times the share. The par value, again, has no effect. The common stock goes up by the amount of shares issued, and there's no effect on additional paid in capital. Why? Because it was deemed to be issued at par. So there's a pretty big difference between the treatment, if it's a small or large dividend, and even a bigger difference when it's compared to the treatment for a stock split.